I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. How to Retire on Dividends by Brett Owens is a fantastic book for those who want to achieve financial independence and retire early. The book focuses on the concept of living off dividends from stocks, which is a popular investment strategy for retirees. The author begins by explaining the basics of dividends and how they work. He then goes on to discuss the benefits of dividend investing, such as the ability to generate passive income, the potential for long-term growth, and the ability to avoid market volatility. He also provides helpful tips on how to find the best dividend-paying stocks and how to create a diversified portfolio. One of the things I appreciate about this book is that it's written in a very easy-to-understand language. The author uses real-life examples to illustrate key concepts, which makes it easier for readers to relate to the material. Moreover, the book is structured in a logical and organized way, making it easy to follow along and understand the various strategies that the author recommends. Another thing I love about this book is that it's very practical. The author not only explains the concepts, but also provides actionable advice on how to implement them. For instance, he provides detailed instructions on how to create a dividend income plan, how to select the best dividend-paying stocks, and how to manage your portfolio for optimal returns. Overall, How to Retire on Dividends is an excellent resource for anyone looking to achieve financial independence and retire early. The book is packed with practical advice, real-life examples, and helpful tips that will help you build a solid dividend income stream and achieve your financial goals. Whether you're a seasoned investor or a beginner, this book is definitely worth checking out. Point 1 of the book, How to Retire on Dividends, highlights the fact that dividend investing is a popular investment strategy for generating passive income in retirement. The main idea behind this point is that investing in dividend-paying stocks can provide a reliable source of income that can help support you throughout your retirement years. One of the main benefits of dividend investing is that it allows you to generate income without having to sell off your stocks. When a company pays out a dividend, you receive a cash payment or additional shares of stock, which you can choose to reinvest or use as income. By reinvesting your dividends, you can potentially grow your portfolio over time and generate even more income in the future. Another benefit of dividend investing is that it can help protect against market volatility. Since dividend-paying stocks tend to be more stable and less volatile than non-dividend-paying stocks, they can help to provide a more consistent source of income, even during periods of market turbulence. Overall, the idea behind point 1 is that dividend investing can be a highly effective strategy for generating passive income in retirement. By selecting high-quality, dividend-paying stocks and creating a diversified portfolio, you can potentially build a reliable income stream that can help support you throughout your retirement years. Point 2 of the book, How to Retire on Dividends, explains the concept of dividends in more detail. In essence, dividends are payments made by companies to their shareholders as a reward for investing in their business. These payments can come in the form of cash, additional shares of stock, or other assets. Dividends are typically paid out on a regular basis, such as quarterly or annually, and are usually based on the company's earnings and profits. Companies that pay dividends are often seen as more stable and reliable than those that do not, since they have a proven track record of generating profits and sharing them with their investors. One of the benefits of dividends is that they can provide a steady source of income for investors, particularly those who are in or nearing retirement. By investing in dividend-paying stocks, investors can potentially receive regular payments that can help to supplement their other sources of income. It's worth noting that not all companies pay dividends, and that dividends can vary widely in terms of their size and frequency. Some companies may pay very high dividends, while others may pay very little or none at all. When selecting dividend-paying stocks, it's important to consider factors such as the company's financial health, earnings growth, and dividend history in order to choose stocks that are likely to provide a reliable, and consistent source of income over the long term. Overall, point 2 underscores the importance of dividends in dividend investing and highlights the potential benefits that they can provide to investors who are seeking a reliable source of income in retirement. Point 3 of the book, How to Retire on Dividends, highlights the idea that dividend investing can help protect against market volatility. This is an important point, as market volatility can be a major concern for investors, particularly those who are approaching or in retirement. When the stock market experiences significant fluctuations, it can have a negative impact on investment portfolios, particularly those that are heavily invested in stocks. This is because stock prices can rise and fall rapidly, causing the value of a portfolio to fluctuate as well. This can be particularly concerning for investors who are relying on their portfolios to provide income in retirement. However, dividend-paying stocks can help to mitigate this risk by providing a more stable source of income. Even if the stock price falls, investors can still receive regular dividend payments, which can help to offset any losses and provide a more consistent stream of income. Furthermore, companies that pay dividends tend to be more stable and established than those that do not. These companies are often well established in their respective markets, have a track record of generating profits, and are better positioned to weather economic downturns. In addition, dividend-paying stocks can also provide long-term growth potential. As companies continue to pay dividends and grow their businesses over time, the value of their stocks can also increase, providing investors with potential capital gains as well as income. Overall, Point 3 emphasizes the benefits of dividend investing in terms of risk management and long-term growth potential. By investing in dividend-paying stocks, investors can potentially generate a more stable stream of income and build a portfolio that is better positioned to weather market fluctuations over time. Point 4 of the book, How to Retire on Dividends, highlights the importance of selecting high-quality, dividend-paying stocks in order to achieve success with dividend investing. This point underscores the fact that not all dividend-paying stocks are created equal, and that investors must be discerning in their stock selection process. To select the best dividend-paying stocks, investors should look for companies that have a history of consistent dividend payments and growth. This means selecting companies that have a solid financial foundation and a sustainable business model, and that are likely to continue generating profits and paying dividends over the long term. In addition to a company's dividend history, investors should also consider factors such as the company's financial health, earnings growth, and competitive position in the market. Companies that have a strong balance sheet, consistent earnings growth, and a competitive advantage are more likely to be able to continue paying dividends and growing their businesses over time. Diversification is also an important consideration when selecting dividend-paying stocks. By diversifying their portfolio across different sectors and industries, investors can spread their risk and reduce the impact of any one stock or sector on their overall portfolio. Overall, Point 4 emphasizes the importance of careful stock selection when it comes to dividend investing. By selecting high-quality, dividend-paying stocks that have a history of consistent payments and growth, investors can potentially build a more reliable and sustainable income stream over the long term. Point 5 of the book, How to Retire on Dividends, highlights the importance of diversification in dividend investing. Diversification is a risk management technique that involves spreading investments across different asset classes, sectors, and geographies in order to reduce exposure to any one particular risk. In the context of dividend investing, diversification is important because it can help to spread risk across different types of dividend-paying stocks. This means selecting stocks from different sectors and industries, and also considering factors such as company size, dividend yield, and dividend growth. By diversifying their portfolio, investors can reduce the impact of any one stock or sector on their overall portfolio, and can potentially improve their overall returns while also reducing risk. For example, if one sector of the economy experiences a downturn, the impact on the portfolio can be mitigated by holding stocks from other sectors that may perform better during that same time period. However, it's also important to strike a balance between diversification and concentration. Over-diversification can dilute returns and reduce the potential for growth, while excessive concentration can increase risk and make the portfolio vulnerable to market volatility. Overall, Point 5 emphasizes the importance of diversification in dividend investing and highlights the need for investors to strike a balance between diversification and concentration in order to achieve optimal results. By diversifying their portfolio across different types of dividend-paying stocks, investors can potentially reduce risk, improve returns, and build a more stable income stream over the long term. Point 6 of the book, How to Retire on Dividends, stresses the importance of selecting high-quality dividend-paying stocks when building a dividend portfolio. This point underscores the idea that not all dividend-paying stocks are created equal, and that investors must be discerning in their stock selection process. To select high-quality dividend-paying stocks, investors should consider factors such as the company's financial health, earnings growth, and dividend history. This means selecting companies that have a solid balance sheet, consistent earnings growth, and a history of increasing dividends. Companies that have a history of increasing dividends are particularly attractive, as this indicates a commitment to returning value to shareholders over the long term. Investors should look for companies that have a track record of increasing dividends year over year, and that have the financial capacity to continue doing so in the future. In addition to these factors, investors should also consider the company's competitive position in the market, its management team, and its growth potential. Companies that have a competitive advantage and a strong management team are more likely to continue generating profits and paying dividends over the long term. Overall, Point 6 highlights the importance of conducting thorough research and analysis when selecting dividend-paying stocks. By selecting high-quality companies with a history of consistent dividend payments and growth, investors can potentially build a more reliable and sustainable income stream over the long term. Point 7 of the book, How to Retire on Dividends, emphasizes the importance of monitoring and adjusting one's portfolio regularly in order to ensure that it remains balanced and aligned with one's investment goals. Portfolio monitoring involves regularly reviewing the performance of one's portfolio and making adjustments as needed. This may involve rebalancing the portfolio by buying or selling stocks, adjusting the allocation of assets across different sectors or industries, or making other changes to the portfolio based on changing market conditions or investment goals. One of the key reasons why portfolio monitoring is important is that it can help investors to stay on track with their investment goals. By regularly reviewing the performance of their portfolio, investors can identify any areas that may need adjustment and can make changes in order to stay aligned with their overall investment strategy. In addition to portfolio monitoring, it's also important to have a clear investment plan in place that outlines one's investment goals, risk tolerance, and time horizon. This plan can help investors to stay focused on their long-term goals and avoid making impulsive or emotional investment decisions. Overall, Point 7 underscores the importance of portfolio monitoring and having a clear investment plan in place. By regularly reviewing and adjusting one's portfolio, and by staying focused on one's long-term investment goals, investors can potentially build a more successful and sustainable dividend portfolio over time. Point 8 of the book, How to Retire on Dividends, suggests that investors can consider exchange-traded funds, ETFs, or mutual funds that focus on dividend-paying stocks, in addition to individual stocks, to diversify their portfolio and potentially improve their returns. Dividend-focused ETFs, or mutual funds, are investment vehicles that invest in a basket of dividend-paying stocks. This allows investors to gain exposure to a diversified portfolio of high-quality, dividend-paying companies, without having to select individual stocks themselves. One of the advantages of dividend-focused ETFs, or mutual funds, is that they can help investors achieve diversification more easily and at a lower cost. Since these funds invest in a diversified portfolio of dividend-paying stocks, they can potentially reduce the impact of any one stock or sector on the overall portfolio, while also providing exposure to a wide range of industries and geographies. In addition, ETFs and mutual funds can also be a convenient option for investors who don't have the time or expertise to select individual stocks themselves. These funds are managed by professional fund managers who have expertise in selecting high-quality dividend-paying stocks, which can potentially improve the returns of the fund. However, it's important for investors to do their own research and due diligence when selecting dividend-focused ETFs or mutual funds, as not all funds are created equal. Investors should look for funds that have a solid track record of performance, low fees, and a diversified portfolio of high-quality, dividend-paying stocks. Overall, Point 8 emphasizes the potential benefits of investing in dividend-focused ETFs or mutual funds as a way to diversify one's portfolio and potentially improve one's returns over the long term. By selecting high-quality funds that align with one's investment goals and risk tolerance, investors can potentially build a more successful and sustainable dividend portfolio over time. Point 9 of the book, How to Retire on Dividends, highlights the potential benefits of reinvesting dividends as a way to compound returns over time and increase overall wealth. When investors reinvest their dividends, they use those funds to purchase additional shares of the stock, rather than taking the dividends as cash. This has the effect of increasing the total number of shares that the investor holds, which can potentially increase the overall value of the portfolio over time. The power of dividend reinvestment lies in the concept of compounding. Compounding refers to the process of generating earnings on both the initial investment and the accumulated earnings from previous periods. By reinvesting dividends, investors can potentially benefit from compounding returns, which can help to accelerate the growth of their portfolio over time. For example, let's say an investor owns 1,000 shares of a stock that pays a 3% dividend. In the first year, the investor would receive $30 in dividends. If they reinvested those dividends to purchase additional shares, they would now own 1,030 shares. In the second year, they would receive a dividend payment based on the new, higher number of shares they own. If the stock price remained the same and the company continued to pay a 3% dividend, the investor would receive $31.44 in dividends in the second year, which is $1.44 more than they received in the first year. Over time, this compounding effect can potentially lead to significant growth in the value of the portfolio. However, it's important to note that dividend reinvestment is not a guaranteed way to increase returns, and that it may not be the best strategy for all investors. Some investors may prefer to take the dividends as cash in order to meet their income needs, or may prefer to use the funds to purchase other investments or pay down debt. Overall, Point 9 highlights the potential benefits of reinvesting dividends as a way to compound returns over time and potentially increase overall wealth. By reinvesting dividends, investors can potentially benefit from the power of compounding, which can help to accelerate the growth of their portfolio over the long term. Point 10 of the book, How to Retire on Dividends, stresses the importance of having a long-term perspective when it comes to dividend investing. This means focusing on the quality of the companies in one's portfolio, rather than short-term market fluctuations or the latest investment trends. One of the advantages of dividend investing is that it can provide a reliable and sustainable source of income over the long term. By investing in high-quality, dividend-paying stocks, investors can potentially build a portfolio that generates a steady stream of income that can help to meet their financial needs in retirement. However, in order to achieve success with dividend investing, it's important to have a long-term perspective and to be patient. This means avoiding the temptation to make impulsive investment decisions based on short-term market fluctuations or the latest investment trends, and instead focusing on the quality of the companies in one's portfolio and their long-term growth potential. In addition, it's important to have realistic expectations when it comes to dividend investing. While dividend-paying stocks can provide a reliable and steady stream of income over the long term, they may not generate the same level of short-term returns as other types of investments, such as growth stocks or high-risk, high-reward investments. Overall, Point 10 emphasizes the importance of having a long-term perspective and realistic expectations when it comes to dividend investing. By focusing on the quality of the companies in one's portfolio, and by being patient and disciplined in one's investment approach, investors can potentially build a more successful and sustainable dividend portfolio over the long term. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.